Hey, welcome everyone. Tom here from Park Avenue Trading, your chief dealer, keeping you sane in these insane markets. But today is going to be a video on the infamous moving average convergence divergence and why I feel that it's kind of an inferior way to trade. But that's just my opinion. But I do have it backed up with some numbers that I had somebody do some research over 3 years worth of data on daily charts. Okay, not on short-term charts. I'm using the short-term chart here for an example. Now, moving average convergence divergence was an intriguing combination of moving average oscillators proposed many years ago by Gerald Appel. And what he did was he took the difference, or he took the approximate difference of an exponential equivalent of the 12 and 26 period moving averages, and he created an oscillator line. And basically, the oscillator line, the exponential equivalents are 0.15 and 0.075. Okay, now the purpose of doing it, was basically trying to get a better indication, of faster moving indication of, a trend change, instead of you just using the straight up moving averages. So that's why he did these, equivalents. He created a second line by taking the approximate exponential moving average of a 9-day or a 9-period moving average. And that was 0.2 of an exponential, right? Now, the term I'm going to use to cover any interview is like a week, a day, an hour, 5 minutes, etc. It's the time period of that the study should match the time period of the chart. So this is a moving average convergence divergence, obviously on a 1-hour chart. Now, you could use it on any chart you want. All right. I basically had to test on the dailies. Now, the two main moving average convergence divergence lines act like a two moving average crossover. So when the short crosses over the long, you're supposed to go long, and it's supposed to, signal and often anticipate a trend change. But through studies, backtesting, comparing this to Richard Donchian's moving averages, this one was kind of inferior. Now, I'm just going to go over quickly like what this thing is supposed to be saying and my take on this thing. All right, so let me just move myself to over here. So if we're looking at this moving average convergence, and this one, because TradingView puts a histogram on it, okay, the crossover occurred here. The blue line is a shorter term. It crossed over here, so basically it got you long on this bar. Okay, all right, not so bad. I mean, really, obviously it would have been better to get long down in here or somewhere close to here, but getting long, on this bar, and the marketplace, if you watch the histogram, it's moving up, it's moving up, it's moving up. You're in the money, okay? And by the time that this thing turns down, now this is the benefit of hindsight, because if you look at this, if you look at the live, all right, it's crossed over, and the marketplace basically could start rallying up, and then this blue line turns back up way after the fact. So like when you're looking at this thing live, like what the fuck does this mean, really? I mean, what does it mean? You don't know. I mean, so far you're still short. You're short. You basically got short right here, okay? Or let's say you got short here. So you went short, the marketplace moved down a little bit. Now it's starting to move up. Now what do? Do you get out? So this is the problem that lagging indicators pose, and this is my feeling on it. I mean, I'm a big proponent of that. Price is the only truth. Price action is the only truth, and it's basically what I teach in my courses: Forex Confidant, Tao of Price. And of course, in the trading room, I'm doing only price action trading. That's a little, disgusting self-promotion there. But hey, why not, right? I mean, I'm giving the lesson, right? So if we just go back in time, let's just say for, as they should say, shits and giggles, and I can pull this up, all right. Right here, this marketplace got you short right here on a 1 hour. All right, right there, marketplace moved down a little bit, by the time it got you out where you lost money. Now, this is the problem when people trade moving average, convergence, divergence. They will have some wins. There's no doubt. Anything's going to have some wins. However, you know, you get caught up in this lagging indicator. You're not really looking at price action per se. You're looking at, you know, what this marketplace, what this indicator is saying. And there is no indicator, you know, other than, you know, price, volume, and, you know, historical data that really gives you, you know, a true indication of what the marketplace is doing. Okay, support and resistance, real important stuff. You know, in a bullish market, you know, support is often holds and resistance is often broken. In a bearish market, support rarely holds and resistance always holds. You know, so that's just it. I mean, you could pick a point here, you know, just for argument's sake, you know, and you could have had a Larry Williams oops trade right there. Much better than this moving average convergence divergence thing. So like here, Larry Williams would say like this, okay, you have a pivot low in the marketplace. All right, marketplace comes down, breaks that pivot low, and on that same, that bar or the bar after, it comes back up into the range. That's oops, he went short on breaking this, and he turned around as soon as it came back up and up above that pivot point. Oops, get long. Now, that's a great little thing. I mean, that's a great little hint right there. But the point is, you got to find the proper pivots, the real important pivots, and that's what I go over in Tower Price. So head on over and get the course. No, just kidding. Anyway, so let me get to some of the numbers over a 3-year period that we'll go over, and you can decide for yourself. I mean, I'm not here to disparage anybody's trading method. Okay. I just, you know, been doing this a long time, and I've seen lots of whipsaws happen in this thing. Then you got to start talking about divergences, you know, where the marketplace has a high, yet the moving average convergence divergence hasn't shown that it's a high yet, so you have a divergence trade, and really it's not that serious. You know, I mean, in my opinion, it's never really made any big bang for the money that you're risking. So let me get over to that little statistics that I have for you. Hang on one second. Let me pull it up. Okay, so I had a guy run some numbers over 3 years on the daily chart. Okay, it wasn't on the hourly chart, because obviously on the hourly chart you're going to get a lot more trades out of it. But historically speaking, the number of closed trades in Eurodollar were 101 closed trades, profitable with 25, so roughly profitable percent was 25%. Now that's fine, you know, because if you look at the total profit or loss, it became 42,650. However, the average profitable trade was 3,744 versus the average losing trade, which was 1,793 overall. So you could say that's kind of respectable. You know, you got a 2-to-1 there, almost, maybe a little bit more. However, the drawdown, the timing, and the losses, the drawdown was 49,400. That's a significant drawdown. You know, if you have a $50,000 account over that 3-year period, you'd lose it. Okay, your average profitable trade was $422. Now that also is pretty respectable. Okay, I think that any system minus, you know, the accuracy has to be there. It has to be constant. It has to be definitely above 25%. You know, it has to be close to like 48, 51%. And you have numbers like this, you're doing fine. Where you get an average profit of 3,744 against your average loss of 1,793, you're good, because you get a lot more of the 3,744 positives than you do of the losing trades. So hopefully that makes sense. However, let's go over euro yen. 97 trades, 40 were profitable, 41%. Average profit or total loss was $480 overall. That I don't understand. So this one actually did pretty well. is average profitable trade of 2,274. You had 1,587. Let me just check that number, make sure I didn't transpose something. No, that was correct. Total profit or loss was $480. Average profitable trade was 2,274. Average losing trade was 1,587. Maximum drawdown was 16,873. So if you took your average profit per trade, it's $5. Wow, not good. Sterling yen. Number of trades closed, 80. 31% profitable, percentage profitable, 39%. Average total profit or loss, $1,675 profit. Average profitable trade was 1,174. Let me make sure that's right. I have it on my notes here. I guess so. All right. Average losing trade was $722. Maximum drawdown. This is actually by far the best one because it does have a propensity to trend pretty well. At maximum drawdown, 8,575. Average profit per trade, $19. Those are the numbers, folks. There's no magic here in this moving average crossover divergence shit. So anyway, I'm glad I was able to throw that out for you. Please, if you like what you see, like and subscribe. Don't forget to ring the bell. I'm going to be coming up with some more technical trading indicators that you can actually compute by hand. We're going to be doing projected ranges in the next video. I think that's really cool, real simple. It's taught to me by a gentleman by the name of Roger White. He's an old floor trader. He taught me his method. Well, actually, it was the floors method of trying to figure out what the range of that day was going to be for support and resistance. And I look forward to seeing you in another video. Head on over to Park Avenue Trading. Get yourself a free ebook. And remember, enjoy the party. Dance near the door. Cheers.